Hi, my name is Girish, your host for today for Back to Basics. Today we have a guest. Well, let's put it this way. We have a guest regarding finance. Not regular finance, mortgage finance. Now, we have had the realtor guy before, back in the days, in many moons ago, whenever we had that. And today we're going to talk about mortgage finance. His name is Vikram Patel. Vikram, thank you for coming on our show.
Thank you, Girish, for having me. Thank you, Back2Basics, for inviting me.
So, Vikram, first thing is first, before we get into the basics of finance, the mortgage finance, I should say, what does back to basic mean to you?
Back2Basics to me means every element of life that kind of touches the human level, whether it's your needs, whether it's your wants, whether it's fear or greed, good and bad, anything that we can relate to on our day-to-day life, anything that applies to a human being's practical life, and anything that can kind of be broken down on a ground foundation level, going back to basics. So, we think of things in the simple aspect of things, or you could complicate it, but I like to think everything from a basic standpoint first before we start building and complicating things.
Yeah, so we're trying to make it as simple as we can for folks to understand the basics of mortgage financing. So the first thing is, what is the common question that you always get between about mortgage finance in general? I have some few questions, if that's okay with you.
Yes, absolutely. I mean, it's a very open-ended type thing where the common questions are many. Everybody asks different questions. Obviously, being in mortgages, the first question is always about the interest rates. That's the zillion-dollar question. What are
Yeah,
they today?
yeah.
There are many more, beyond from that point. So I'd love to hear the questions you have.
So the question that I have is, when we see mortgage rates, 1.85, 2.76, and all that stuff, is that more FHA interest rate or conventional?
The short answer is conventional. I mean, most of us are used to going online or hearing the rates on either TV or radio. And generally, the advertised interest rate marketplace is talking about your conventional loan.
Hmm.
Notice that an advertisement typically has one rate that they mention, right? It's not a range of rates.
Hmm.
So the one rate that they're presenting is typically the best rate for the best case scenario. And there are certain underlying assumptions behind that rate. So the assumptions can be the type of property, the location of property, the down payment of an individual, credit score assumptions.
Hmm.
So you package all of that into a best case scenario, that's typically the rate that you see advertised out there. But to answer your question, conventional rate.
So, do you think that we get a better rate when we have better score, or do we have better rate when we have crappy score and a lot of down payment to that place?
So it's a case by case basis, but if I had to pick one, which is how the mortgage world and the banks view it as, credit is king, right? So typically your credit score is going to be the number one factor. Down payment becomes a compensating factor.
Hmm.
If you have perfect credit, banks want to loan you as much as they can. You're the perfect candidate.
Hmm.
So typically don't want you to put a large down payment as a compensating factor because they're willing to take that extra risk on you. And you may get an excellent rate even with as little as 3 or 5% down or whatever the minimum requirements are for a given program at that point in time. Now, of course, when your credit scores are compromised or they're poor, then the compensating factor becomes the down payment. So in order to secure a good rate, you would be required to put a higher down payment. Somebody with a combination of poor credit and less down payment is typically going to be on a whole different planet in terms of rate compared to what people are seeing used to and
But
advertised.
Vikram, there is some few people who have bad score, but then they have good rate. Is it because they have a FHA loan, and then that's where the insurance comes in, and that's where the risk factor insurance comes in from the bank point of view?
Yes, absolutely. So there's a category of mortgages called conventional, which is what people are used to looking at. And
Yeah.
then there's FHA, VA, USDA, which fall under the government mortgages umbrella. And contrary to popular belief, these mortgages make up about 46% of mortgages originated in America,
Hmm.
in mostly any calendar year. So the FHA rates are typically lower, despite the fact that the category of borrowers there come with lesser credit scores, lesser down payments. And the reason they are still able to secure better rates is because those mortgages come with an insurance policy that reduces the risk on part of the bank.
Hmm.
FHA, Federal Housing Administration, charges an upfront mortgage insurance premium as well as a monthly premium on that loan to insure that policy. So, going back to what you asked, Girish, yes, typically lesser down payment, lesser credit scores with a combination of good interest rates typically mean government insured mortgages.
Mm. So what's the difference between whatever interest is out there? Let's say with this example is 2.75. Let's hypothetically say that. But what does it mean by when they say ARM 1%, 2%? What does that mean?
So ARM rates are adjustable rate mortgages. These were more popular in a time frame where rates were aggressively higher. Back in 2018, 2019, when your average rates were in the fours, ARMs were still fairly popular where you start off with a low interest rate for a given amount of time frame. Typically, it ranges on a 1 year, 3 year, or a 5 year time frame as the more popular products.
Mm-hmm.
And your rate is fixed at a low rate for that time frame, but once that time frame passes, the rate becomes subject to variable rates of whatever the rates may be prevalent in the market at that point. So you could start with a 2.5% rate, and 5 years later, when that time period expires, you could very quickly shoot up to a 4, 5, 6% rate.
So the safest bet is with your example, the 5 year, let's say ARM, with your example, which means that I need to finance my house within 5 years to get away from
Yes.
that penalty, as they want to say it.
Yes, you could either refinance or you're planning to sell and move to a different place. But the point is you're not looking to hold that mortgage beyond a certain time frame.
So
Now, in the current interest rate environment, ARMs are really not something banks are promoting, nor is it something customers are asking for, because we already have the best historically low interest rates right now on the fixed products.
But if we get the ARM, for example, Vikram, before we get to the next topic, do you think the bank will put an insurance on there as a risk factor for those 5 years? So how does that usually work?
So typically, ARMs fall under the conventional mortgage umbrella.
Okay.
Is for people that are coming in with the 15, 20% or higher down payments, there is no insurance policy. So regardless of whether it was an ARM or a fixed rate product, there wouldn't be an insurance policy required for that loan. But now in cases on conventional mortgage where people are coming in with 5 or 10% down payment, there is a private mortgage insurance. That's why they call that the PMI.
Mm-hmm.
On the HA world, they call it simply MI, mortgage insurance. And that PMI would be there on ARM as well as a fixed rate product because of the fact that the loan to value ratio is high and the down payment is lesser. And there's insurance required on that mortgage.
But usually, I might be wrong, but I thought the PMI is more of less than the percentage of the equity of the house. Is that not the case?
So PMI applies because the equity going into the house is less. So the bank's risk is higher. The loan to value ratio is higher. So simply put, if somebody's putting 5% down, their loan to value ratio is 95%. It means the bank is taking 95% of the risk on that property, which is a little excessive. And that's why they need an insurance policy associated with that loan. As far as the interest rate characteristics, whether it's floating or fixed or whether it's adjustable or not, regardless, at that moment, an insurance policy is required.
So guys, you have to understand, it doesn't matter what year of the conventional you have. Is the ARM is only fixed for a certain time period. It could be 1, 3, or 5 year, depending on what Vikram has explained here. So try to get away from that ARM because it seems like nowadays the banks are advertising other conventional tricks in the bag. Is that correct, Vikram?
Correct. Again, the focus is not so much on ARMs right now, but sure enough, if the rates shoot up like they have been in the last 2 to 3 weeks, and if we get back closer to that upper threes 4 handle, you'll start seeing a lot more promotion of the ARM products again and a lot more inquiries coming through. Right now, we're still closer to the 3% mark on the 30-year fix. So psychologically and in reality, both ways, we're near the lows. And people do feel that the risk here is more to the upside. They don't think the rates are going to drop too much from here. And so you get a lot more demand of the fixed rate products, which for good reasons, it makes sense to do that right
So
now.
Vikram, I'm not saying that you are the guru and you understand, the rates and all that stuff, but what is your forecast prediction for at least the second or the third or the fourth quarter for this year? What do you think?
Again, I mean, there's no magic crystal ball here, but you could just look at the facts. And the facts are that the Federal Reserve has wanted inflation for some time now. They want to hit a certain target inflation level. And we're starting to see evidence of that happening, primarily through the home price increases that we've observed in the last few months, particularly after the Thanksgiving weekend up to today, where on average, a good suburban real estate is up 10% or more.
Mm-hmm.
That's a good sign that inflation is here. And typically, when inflation signs arise, the bond market investors don't like that. Inflation is the arch rival enemy of bonds. And when the bond market starts to go into a sell off mode, typically the rates go up. And we've already started to see that effect in the course of last 3 to 4 weeks. As of right now, we don't see any reasons why that's going to reverse. We think that momentum is going to continue for the rest of the coming quarter or two.
Mm-hmm.
I think for now, the risk is more to the upside on rates. And if they do dip a little bit, that might just be a dip, temporarily short lived, followed by much higher interest rates.
Oh, thank you for that. So let's talk about refinancing here for a second. So refinancing is getting very famous now because of the rates being lowered. Do you think it's a good idea to refinance versus a loan term versus cashback? How do you define that?
It's been a great time to refinance. 2020 in the mortgage industry was a record refinance year across America, probably the busiest years we've seen since the 2004 2005 timeframe when mortgage originations were at a peak at that point in time. 2020 was more geared towards refinances. But what we're noticing now is that the reasons people refinance are many. There was a time when people would think of refinance as a means to drop their monthly payment and save on their rate. Not necessarily the case anymore. I mean, rate is an important factor, but what we're seeing is people are wanting to refinance sometimes to take a cosigner out of the equation that may have helped during the time of the purchase. For people that are in the house for 5, 10 years and that have had the chance to build up equity, they're looking to extract that equity out either to pay for their kids' college or to consolidate their credit card and car payments and take advantage of the low rates right now. And of course, people want to also go from a 30-year loan to maybe a 25, a 20, or a 15. And once in a while, you see the vice versa, where somebody really has 15 years remaining and wants to go back to a 30 because they want to simply just reduce their monthly debt load. So, with the market being so efficient and the focus being on refinances, what again we've noticed is the reasons are many, and it's not just one mindset anymore to trigger a refinance.
So, is it a wrong thing to? I'm not saying that there's a right and a wrong answer, Vikram, but do you think it's not right to bring other loans into the mortgage loan itself? It seems like you're increasing the value, aren't you? Or am I wrong in that? For example, just like you said the student loans and the car loans. Do you think that's a good example to do that?
It is for the people who have the equity in the house, and this is where banks have gotten smart now. They're making sure there's no leverage cost because of this flexibility. So they're typically restricting any kind of consolidation or cash out loans on a home down to 75%. What that means is at any given point, you have 25% equity in the house. So the only people that are really able to take advantage of that cash out are people who currently have 50, 60, 70% or more equity in the house, and they're able to extract enough to get down to that 25% value. So it's not, there's no adverse effect of this because you're not leveraging, you're not artificially inflating loans, nor are you increasing the risk on the part of the banks where the bank is again held, with a 95% mortgage. And God forbid, if the economy slows down or if prices come down a little bit, there's no underwater or upside down scenario that can unfold here.
Yeah. So Vikram, thank you for that, because it seems like a lot of people are refinancing for different reasons, and it could be right and wrong. Everyone's prerogative what their reasons are.
Yeah.
We can't
Different phases in life for
different
different
phases of
people.
life for everything. I mean, Obviously, my phase of life would be, my kids going to college. So I might be thinking of that terms. Some people will be thinking of paying off the student loans. There would be
Correct.
some who just bought a new car. Maybe they just refinance due to paying off the car. It could be many, many different reasons, right? Uh,
Yeah, and just to sidetrack a little bit, I'll comment on the student loans. Lately, we're seeing people not wanting to consolidate student loans because they're hoping that our politicians are going to somehow forgive the student loans. So we're also seeing that where
yeah.
people would have normally consolidated are saying, well, wait a minute, let me not bundle up my student loans with my mortgage.
Plus, I think the interest rate is much higher in the student loans versus the
Correct.
mortgage loans. So that could be one of the reasons why that factor comes in play.
Mhm.
Okay, so Vikram, regarding appraisal, it seems like it's a
It's a hot
big,
topic.
it's a hot topic for almost everybody. They don't know what appraisal is. Um, do I just go to, what is it, Zulu.com or something like that, and figure out that, oh, my house is like 900K? Or what is the algorithm versus that versus an actual algorithm of the appraisal?
So public websites like Zillow or Realtor or Trulia will sort of they have their own data crunching engine that's going to spit out an estimated value, and there's nothing wrong with that. But where they miss the buck is they don't really analyze the condition of the house or the upgrades an owner may have put in,
Mm,
the unique characteristics of a specific property. So a bank appraisal is a very formulaic approach, and there's a 22-point guideline really incorporated by the government, and these appraisers are sort of responsible to hold up to that guidelines. So when an appraiser physically goes out to the property, obviously they're still looking at all the similar data that some of those public engines are looking at. But in addition to that, the appraiser knows how to take into picture what the unique characteristics of that house may be, the square footage value of not just the house, but the neighborhood and other neighborhoods similar to that, the condition of the house, the upgrades somebody may have put in. And of course, the appraisers also look at what other properties are under contract in that similar neighborhood at that point in time. And that may be a factor or a data that some of these engines miss because sometimes not every public website knows that there was an offer accepted on a house yesterday that's
but
under contract
but
today.
Vikram, I'm sorry I'm cutting you off, but when we refinance, they usually tell you that your value of the house is 900K, but Zulo tells me 950. So how do you defer that versus what the bank says when you're refinancing versus the appraisal?
Great point. So what Zillow tries to do is, let's say, Girish, in your neighborhood, if everything was selling for 900, now you have this one house that sold for 950. Zillow is overnight going to start increasing value on every single house in the neighborhood. And there's nothing wrong with that. But the challenge becomes that when a bank appraiser comes out, they are looking at that one comparable that sold at 950, but they're still supposed to take into aggregate an average of three or four comparables. And now, because you have two or three other ones that are still sold at 900, that appraised value is going to come in lesser compared to what either Zillow is showing you. And sometimes in this market, it's definitely coming lesser than what the buyers are willing to offer for a house. But right now, the reason we call it a hot market is because of the supply demand imbalance. So, what does that mean? It means people are willing to pay above and beyond what the bank valuation is or the true value of that house is.
Mm,
So appraisal by nature is going to be a lagging indicator because the market's always ahead. The market's willing to pay you 50,000 more than what the value of that property is, but that doesn't mean an appraiser is going to come in and give you that value. Because the appraiser still has to look at the average of a certain amount of properties in that neighborhood
mhm.
and then look at the sold data. And data is again a lagging indicator, right? It's after the fact.
Mm. Yeah, so I mean, so regarding appraisal and cosmetic, now people they get a little confused about how much money that I put in, and I think I should get that money back. So
Yes.
the reason why I'm saying that is, let's say I do my stairs, I do my foyer, I do my bathroom, I do my kitchen, I do everything else. Do I do all that and get my monies back, or is
Not all
there?
of it.
Go ahead, go ahead.
So there are certain areas where you get quite a bit back on the appraised values, and I think the marketplace has sort of decided, not just now through history and through various sample sizes of thousands of households, that the kitchen and the bathrooms are typically the high ticket items where you typically do get 80 to 90% of the value back in terms of the upgrades,
Mm.
followed by roofing, siding, windows. The HVAC systems are another high value item, and then followed by flooring. So when we talk about cosmetics, and if people are going to focus on, the backsplash or the paint colors or the crown molding, those are not going to be your high return on investment type values that come back on appraisal compared to some of the things I mentioned earlier, such as the roof siding, windows, the HVAC, or the kitchens and the bathrooms.
Mm.
But what's interesting, though, one thing we've seen since COVID is historically swimming pools was a big thing where people would go spend 100 grand in their backyard and they would automatically expect that their house should somehow come up another 100 grand in value. That was never the case. Through history, that was sort of the worst investment where you only got maybe 20% of the money back on an appraisal.
Mhm.
COVID, though, swimming pools have become hot commodity, and so now we're starting to see that the marketplace and the appraisals are coming back with 20 instead of 20% historically, almost 50 to 60 to 70% of that backyard money is coming back on appraisal.
Yeah.
That's it's a good cultural shift. It shows the demand from the marketplace and kind of also shows how banks have started to think of these properties with that resort feeling.
When you talked about the pool, I understand that there's a lot of hot hot item nowadays due to COVID. Okay, now that's more of a pivot change if you really think about it. Now,
Yes.
the another pivot thing that I've actually noticed is people, they want projectors, they want screens, they want the pavers to be nice and clean. So we don't have to go out in public because now things are dangerous now, right? And I
Mhm.
shouldn't say dangerous. I should say more curious. They want to be careful when they go out. So pavers are a new thing nowadays too. Do you think, or is that a regular thing?
No, pavers are definitely popular. Again, a costly item. It's not going to give you as much return on the appraisal as some of those other items mentioned earlier.
Mm.
But compared to its own history, if pavers would have historically added 5% of the value, maybe that 5% now goes to 15%, or maybe you'll get a much more value compared to history, but nowhere close to the earlier mentioned items.
Yeah.
This is more cosmetic, it's looks, and that can change based on, COVID, no COVID. What's in demand today may not be tomorrow.
Yeah.
But again, we talk about back to basics, and going back to basics is still the kitchens and the bathrooms and all those other items mentioned earlier.
Okay, so Vikram, regarding COVID-9 and COVID-23, 2032, whatever next one we're gonna get, if we're not gonna get, knock on wood, right? But why are the inventories very less now? What is people moving away from the cities and coming back to the hometowns, or how does that work?
There's so many different factors. Obviously, the biggest factor that sort of expedited all of this is COVID, where we saw the transformation from city population into suburbs, and that's not just true here in Central Jersey. It's true in every metro area and suburb across America, and even to some extent, it's true globally in several countries. If you kind of look at the top 100 metro areas of the world, it's a similar type transformation where people want to get out into more space. And it makes sense, right? I mean, during the lockdown, these are the people that suffered the most. I mean, imagine going into a hallway where somebody sneezes and now you've got to be locked down because you don't want to pass through that area or you don't want to be on the same elevator.
Mm.
It's with us here in the suburbs where we were able to still get out in the neighborhood and kind of take care of our mental health when it was most important during the lockdown.
Mm.
So that's one big factor. But what people don't realize is inventory challenge has been here for the last 4 to 5 years. We always used to joke around at work back in 2017 and 18 that, hey, how are we going to solve this inventory problem that's there? And the answer is we're not. It's not a quick fix, and it's only getting worse. Um, Several reasons. Number one, there's a labor shortage on part of builders and contractors. They just don't really have the manpower needed to build homes. Land acquisition is not as much of a problem. Credit's not the problem, but shortage of material, believe it or not, is the problem, and that sort of got expedited with COVID as well. We started seeing, HVAC systems prices go up, even the simple basic lumber prices.
Mm.
If that tracks commodity markets can realize the lumber prices just until last week were at an all-time high, and still there's a shortage. So between the labor shortage, the material shortage, with the demand kicking in due to COVID, everything kind of just got expedited. But we've had this inventory challenge for several years now, leading, going back to 2015, 16. And it's because I guess when we had the big recession back in 2010, builders just sort of expected to be at a slow pace and didn't realize how fast that economy healed with the help of the Federal Reserve and with the help of technology, obviously. I mean, imagine if what we're facing now with COVID, if this would have happened 15 years ago, we wouldn't be on this Zoom
We
meeting.
would make right.
So the demand was sort of expediting already pretty quickly before COVID, but then COVID took it to a whole different level.
Yeah, yeah.
And now
So
at the point where inventory is at a record low. In some zip codes, it's as low as 80% below a 7-year historical average.
So, guys, I want to explain something here. What Vikram said nicely in, in the back to basic moment here. If you think about it, we maintain our house, keep it simple as you can. But yes, you have to be up to par. You have to make sure your AC unit is up to date and your kitchen is up to date, your bathroom's up to date. But go back to the basics. You don't have to go extreme. Just look at the basics of how to maintain your house and get the value of the house. The other thing, what Vikram also said is keep in mind, yes, we are in the COVID situation. We will be getting out of the COVID situation. And hopefully we will, get the inventory back the way it is, but not anytime soon, as what he said. I think it's been going on for 4 or 5 years. But just keep in mind, nowadays, when you put the house on the market, it is gone in minutes. When I say minutes, I mean within a month. It's gone out of the market. So just be careful when we're putting on the market. It's gone. So here's another question for you, Vikram. Do you think buying and investing, which one is better nowadays?
Primary homes are always the best, right? Because there's going back to basics, there's the human value with it. It's not just a financial decision. It's probably the most emotional decision, even for the most practical people in life that like to believe that everything to them is a calculation, it's a formula. They don't involve human emotions and finances. Even people like that, when we get to the closing table, when we are during going through the mortgage process and the motions, it is an emotional journey. So for a primary home standpoint, buying makes all the sense.
Hmm.
But people that are fortunate enough to be in a position in life where they are looking to now get outside of a primary home and they have the risk appetite and they want to do something with their money, investment homes are obviously a good, viable alternative. And that's where you really can separate your emotions and kind of just look at everything formulaically and on paper and see if the numbers make sense. And if they do, it's a great time right now to buy it, particularly because rates are low and rents are again climbing, particularly in the suburban areas. Again, that transformation from city to suburbs, where you have people from North Jersey or the New York market coming into Central Jersey, which is again putting upward pressure on rents. So if you're an owner of that investment property, you're able to reduce your mortgage through lesser rates and at the same time come into higher rent payment. It's helping both ways.
So, Vikram, one last thing before I let you go. Um, do you think renting is better or buying is better?
In this market, buying is still better because going back to that point I mentioned about inflation earlier, what people don't realize is inflation starts with primary housing. And in this case, when I say housing, I'm not talking about a physical house.
Hmm.
I'm talking about roof over your head. Whether you're renting or owning doesn't matter. And when inflation kicks in, it's really a devaluation of currency, and prices of putting a roof over your head escalate the first before you start seeing those trickle down into your food prices or everything else that you may be looking at on Main Street. So these rents are likely to keep going up. There's really not a cap anytime soon. Affordability is still there. Job market, contrary to popular belief or expectations, remain quite healthy with the help of technology, of course, as we were mentioning earlier. So if rents are looking to keep going up and there's no limit anytime soon, you might as well still buy into a house and lock up your payment for the next 15 or 30 years and then just start enjoying that.
So basically, when you're saying you're buying the house, which means that you're getting good fortune into your pocket, and meeting and preparing for yourself for the later for the future. Is that how we look at it?
Absolutely. And also, right now is a good time because if you are a credit-worthy buyer, you don't really need a lot of money in pocket to get into a house. And 5% down, 10% down is a good enough amount to secure a home. And then if this inflation story persists, which for now it seems like it will, and the supply-demand imbalance is at such extreme levels where it's going to be a multi-year process to unwind that.
Hmm.
So prices of homes or rent are going to keep going up. So the earlier you get in, the better off and the quicker you're going to be on the right side of the equation.
Yeah. So Vikram, any last words before we let you go regarding back to basics for you?
Well, Girish, thank you for having me. I mean, housing is as basic as it gets, so I definitely encourage people to look into homeownership and make that a priority. The longer you wait, the more harder it's going to be, and obviously, the less financially beneficial it's going to be. So, with that said, Girish, thank you for having me at Back to Basics, and this was great. Thank you.
Thank you again, Vikram, for coming on my show, and I'll keep on tapping you if I have any more questions and from my viewers and my listeners. And thank you again, Vikram, for coming.
Absolutely. Thank you.
So, guys, we spoke with Vikram today. We spoke about the do's and the don'ts of the housing financing and refinancing and conventional, and what's the ARM term, what is not the ARM term, and you know, there's no right and wrong answer. It's only opinions. If you really think about it, at the end of the day, that's what we are trying to do. We're trying to make awareness to people about finance, about mortgage finance, that is. So, guys, as always, there is a quote of the day. The quote of the day is, we should remember that good fortune often happens when opportunity meets with preparation. That's by Thomas A. Edison. So, guys, as usual, as always, at the end of the episode, I always say, remember, everything in life goes back to basics, and that's what we did today, guys. Guys, keep on listening, keep on subscribing, keep on commenting, good or bad. Either way, it'll make my show stronger as much as I can. And guys, God bless. See you next week. Next week's episode on Back to Basics.
So that's what I feel. That's what I feel the Mother's Day is about. It's not just a one day thing. It's more or less kind of like a lifetime journey of being a mom.
And thank you for that. So, Bhavna, how about you? What does Mother's Day mean to you?
Well, I think Mother's Day means just finding an excuse to make the person feel special at least one special day of the year. Though I think every day would be as important, and any day where you really find time and